Happy New Year, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Tuesday, January 2nd, 2024. So thankful I hit that. I thought I was going to do 23. So off to a great start. So let's talk about last week in terms of economic activity. Nothing to report. It was the lightest week of the entire year. We had one metric that came out, initial claims, which was a little higher than expected, 218,000. Expectation was 207,000, but the trailing 12-week period was average 214, so it's really kind of noise. So I would say no economic data last week that really had anything to do with the markets. So let's just take a look at where we're at on the very key items that most investors are focused on. Certainly the Fed and what they're going to do with rate hikes. So let's just take a look at where that sits right now. So the March 2024 meeting, the expectation now is a 69% chance that we get a 25 basis point cut. It's almost flat from over the week before, not a big deal. But I think the most interesting thing, and you've probably heard it, that investors have built in this expectation of 6 interest rate cuts, or the equivalent of 1.5% over the next year, which to us seems high. Unless the economy really rolls over hard and pretty soon, really don't see that happening. Nonetheless, that is the expectation built into the Fed funds future market. And when you take a look at the December expectations, there's a 99% chance that we get at least 50 basis point cut between now and the end of the year, and a 71% chance that we get 5 or 1.25%, and over 50% chance that, again, that we get those 6 interest rate cuts. We're betting we don't get all of those. We'll see. The reason we're not expecting 6 rate cuts this year is the strength of the U.S. economy. Continues very strong. Third quarter was unbelievably strong. 4.9% GDP growth. First half of the year was about just a little under 2.5%. That with the third quarter and the expectations for the fourth quarter. So we take a look at the Atlanta Federal Reserve. Their expectation is fourth quarter grew now at 2.3%, a little down from the week before, which is 2.6. Nonetheless, 2.3% real GDP growth is a very solid quarter. So the economy is chugging along very nicely. We're looking for those data points that look like we're going to have a turning point in the economy. So far, those have not shown up. So investors and their expectations for inflation, that has come down. This is something I haven't seen much commentary on, but over the last 2 months of the year, the expectation for 10-year inflation came down from 2.5%, ended last Friday at 2.16%. So expectations for future inflation at a very low level, one of the lowest levels of 2023. So last week, again, no real economic activity. We finished off. It was a very light week in terms of trading, but positive just across the board. So S&P 500 up a little bit, 0.34%. Equal weighted S&P up a little better than that, 0.5%. The international markets, we have the developed markets up over 1%, and emerging markets up 3.2%, largely because China rebounded. China had a horrible year in terms of equity returns, but the Chinese equities were up 4.9% last week. So Chinese equities finished the year minus 13.3%. The S&P finished 2023 up 26.3%. So nearly a 40% beat by the S&P 500 versus Chinese equities last year. So again, just a all-around great year in equities in terms of the U.S. S&P again up 26.3%. The equal-weighted S&P up 13.7%, but that has certainly been improving the last couple of months. NASDAQ growth definitely outperformed in 2023. NASDAQ up 43.4%. Remember, that was down about 40% in 2022. So it was a very good year, and Russell 2000 came on very strong at the end of the year, up nearly 17% for the year. Fixed income last week, another very solid week. The 2-year was down 8 basis points in terms of yield, 10-year down 2 basis points. So the Bloomberg U.S. Aggregate Bond Index was up 0.5% last week, finished the year a positive 5.5%. And you probably heard this if you've seen any of my previous podcasts. But the Bloomberg U.S. Aggregate Bond Index was in negative territory just 3 months ago. So that's an amazing rally, bond rally that we saw in the fourth quarter, really the last 2 months of 2023. So in terms of economic data points for this week, things pick up very strongly at the end of the week. We start off Wednesday, we have ISM Manufacturing Index. You've heard us say several times during 2023, we've been in a manufacturing recession here in the U.S., expected to continue. It's been well over a year since we had an ISM manufacturing reading over 50. Again, 50 is a demarcation line. Below that is contraction. Above that is expansion. It's expected to be below 50 again, but a little bit better than we saw in November. November came in at 46.7. The expectation for the December reading coming out on Wednesday is 47.1. Also on Wednesday, we get the FOMC meeting minutes from December. Unless there's something very unusual in there, that's probably not a market-moving event. But then we move on to Friday, and this is where things start to get really interesting. People are, again, just focused on the strength of the economy and anything that indicates the Federal Reserve will or will not increase rates. So obviously, payrolls, job creation, very key indicator. So on Friday, we get non-farm payroll, and the expectation is we're added in December 162,000 new jobs. Now in November, that was 199, and 162 is definitely well below any trailing 3, 6, or 12-month period. So it's definitely the labor markets have been cooling. We've had some data that suggests it's maybe better than people think. But Friday will be a big data point, that 162,000 being consensus. Now, the actual number versus consensus over the last year and a half has almost always been above consensus, so a lot of focus on Friday's non-farm payroll. The other one, there are some other non-farm private payrolls as well as unemployment rate come out on Friday. We're not going to focus on those. But average hourly earnings, very key to us. The consensus is a positive 0.3% in December. And the reason this is such a focus for us, again, is inflation and the consumer's ability to continue spending and hopefully actually have a real wage increase. We saw that a couple of times, at least on monthly data, in 2023 after the consumer losing tons of ground to inflation over the prior 2 years. So average hourly earnings expected to come in at a positive 0.3. In the month of November, that was a positive 0.4. So lower is actually probably better. 0.3 would be ideal, I think. Last thing is the ISM non-manufacturing. That's the service index. Unlike the manufacturing index, this has consistently been above 50, really hovering 53 to 56 all of 2023. And the expectation is that'll come in at 52.5 following a November reading of 52.7. So that's it for the economic recap and the preview for this week. Thank you very much for your attendance and hope to see you again next week. Thank you.